The next topic is on seller transactions. This is when either a wholesaler sells to a retailer or a retailer sells directly to the customers. The transactions for sellers are a little more complicated than the buyer transactions. There are two entries for this transaction, but the good thing is that you already have been doing one of them. First, you need to record the revenue from making the sale. This part you should already know how to do because we've done this before. You debit either cash or accounts receivable and credit sales revenue. We are going to be dealing mostly with transactions that use accounts receivable instead of cash. The amount will be for the sale amount. The next entry is new to you. Since we are dealing with inventory, we need to show that we sold inventory, which decreases that account. This is also when we expense the sold inventory to cost of goods sold. Remember in the first topic, I stated that inventory is an asset until sold, then we expense the cost. Cost of goods sold is the debit because expenses have normal debit balances. Merchandise inventory is the credit because it's asset and it's being reduced. We no longer have this inventory because it is sold. The amount we use here is not the sale amount, but the amount that the inventory had cost us. The amounts for both entries will not be the same. For the first entry, it's the sale. The second is our cost. The difference between the two is our gross profit. If you use the same amount for both transactions, then essentially you are breaking even. This slide starts off as a duplicate from the prior topic. This is for the shipping expense transaction. As a reminder, the seller will give the goods to the public carrier, who will then deliver it to the buyer. FOB destination means the seller pays, while FOB shipping point means the buyer pays. Remember that only the company paying for shipping will make the journal entry. The journal entry for the buyer was a debit to merchandise inventory and a credit to cash. For the seller paying the shipping, the credit of cash will be the same, but we are not debiting merchandise inventory. We will debit the account delivery expense. Please note that this is the account this textbook uses, but in the real world, you can also call it shipping expense, postage expense, and so on. The reason we are using this account instead of merchandise inventory is because once we sell the inventory, we no longer have it, so we can't add this cost onto something we don't have. When you're the buyer, it becomes part of your inventory cost, but with the seller, it becomes a selling expense. Now we will learn about sales returns. This is similar to the process of purchase returns. Remember in the prior video that when we made a purchase and wanted to return it, we would just reverse the purchase. Now, with making a sale and having that sale returned to us, we also just reverse the sale entry with one minor change, which I will explain next. When the merchandise is not defective, it means that we, as the seller, can put the returned goods back into our inventory to be resold. We reverse the two entries made from the sale. The only change is that the sales revenue account will be called sales return and allowances. As you can see here, when we made the sale, we debited accounts receivable or cash, so now we credit it. For the sale, we had originally credited sales revenues, so now we are debiting sales returns and allowances. We use the amount from the sale here. The second entry is a straight reverse from the sale. Instead of debiting cost of goods sold and crediting merchandise inventory, we do the opposite. Remember, the amount here was our cost. I do want to explain why we don't use sales revenue, but sales returns and allowances instead. If a business has a lot of returns, wouldn't that indicate a problem? Is the product inferior, made with poor materials? Was there an issue with shipping the item? Was the wrong order sent? Managers need to ask themselves these questions in order to fix the problem and avoid returns. We put the returns into this account to keep track of how many of our sales were returned. The account is a contra revenue account. This means it is in the revenue section, but lowers our revenues, which makes sense because the goods were returned. We will look at this more in the last topic. Now, if some of the goods are defective, meaning we can't put them back into our inventory, then we expense it through the loss from defective merchandise account. Just think about what happens when you get the wrong order from a restaurant. When you send the food back, they don't serve it again, or at least I hope not. It gets thrown away. This would be a loss. Now, restaurants don't normally use the perpetual inventory system, but this example proves my point about defective goods. Whatever we spent on the goods that cannot be put back into inventory will be the amount that goes to the debit loss from defective merchandise. However, our focus will mostly be on if goods can be put back into our inventory. Our last entry to learn for this topic is when the seller receives the final payment from the customer. The entry is simple when there is no discount given. We've done this entry before. We are collecting cash because someone owes us money. Cash will be debited and accounts receivable will be credited, since the amount due to us will be removed once they pay. The amount would be the full amount since there is no discount. It does get a little trickier when there is a discount. We still use the same accounts, cash and accounts receivable, but we need to include a third account to account for the discount. This is what the journal entry looks like. Let me start at the bottom. We will still credit accounts receivable for the full sale amount because their full debt needs to be removed. Next, we debit sales discounts for the amount of the discount. Sales discounts is a contra revenue account, just like the sales returns and allowances account. This account is in the revenue section, but it reduces the amount of revenues, which also makes sense because the company does not earn as much in sales if there are discounts. We will cover this more in the last topic. Finally, you debit cash for the amount of cash that we are actually receiving. This is the sale amount less the discount.